YouTubers, welcome to the Independent Investor for Sunday, April the 26th. I recommended one purchase I did the other week was Heinz, Kraft Heinz, and at the time I said I'd look into their rating on the long-term debt. Before I do that, I'll just have a quick look at how that stock did last week. And it, like I say, I talked about, I did a covered call on it and I bought in around 28. So it did go up a little bit, 29, 23. You can look at that video on why I bought it. Just basically it's a food play, pretty secure, and the dividend was very attractive at 6.5%. But I did say last week that I would look into the, just go to Moody's and look at their credit rating. And I gotta admit I was a little bit surprised for such a big company, and this reflects kind of on a lot of the U.S. companies and how much debt they've built up since, say, 2009, and how that can lead into some troubles if the market, if the economy continues to slow down. We could see get-to rates increasing quite a bit. So with Heinz, I went to Moody's, and it's rated for the long-term debt as a Baa3 for the long-term debt, and a P-3 for short-term debt. And this is from Moody's, and we can see here that Baa3 is the borderline between investment grade and non-investment grade. So here you have a company like Kraft Heinz, which you would just assume, being like a major blue chip, would be up in AA2, maybe AA3, but up in this area here. And it makes me wonder how many other companies have taken on so much debt that we think are blue chip that are on the borderline of dropping out into non-investment grade. So it says Kraft Heinz Baa3 senior unsecured rating reflects its large size, global scale, leading portfolio of brands in multiple food categories. It is one of the largest food companies with revenues in excess of $24 billion per annum. The company's operating profits margins remain strong relative to peers, although planned increase in investments in brands and workforce will begin to erode profitability. The high financial leverage and aggressive financial policy constrain upward rating potential. So it even looks like in the future that is not going to improve, say up to a Baa2 or something like that. So I found that kind of surprising, and this illustrates corporate America and how much debt they have taken on. And something interesting could happen here. As I've mentioned, I'm watching the bond spreads between treasuries and, say, your triple Bs and your junk. Now, even if rates don't change, there's a big spread here. Like if you go from A2 to A3, you might be looking at 20 basis points or something like that. But if you go from investment grade to non-investment grade, there's a big difference, and I'll show, because now a lot of pension funds, a lot of mutual funds, Other financial companies cannot own that. That's just their policy. So that means the stock would have to be dumped and could drive down the price quite a bit. So I'm not selling the stock because I want the 6.5% dividend, but like I say, it's so hard to find really good companies now. I look at 2,000 or so and I'm still can just find like a handful of investments that kind of I feel comfortable with. I think their earnings, because it is one of the largest food categories and people shopping at grocery stores and everything else, that hopefully the rating doesn't get dropped. But here's an example if it did. And like I say, they got $20 billion in debt, almost equivalent to their income. And you see that a lot. A lot of corporate companies where their debt is the same as their annual income. And this here is the triple bond, which I've talked about. And it spiked all the way up to 5%. Of course, the Fed came to the rescue, so they're going to bail everybody out, corporate bonds, what have you. And it came down to we're just over 3%. But if they were downgraded from a BBB bond into the junk territory, then we see the yield on the junk is up about, what do we get? Probably about 7%. So from 4%. So you would be looking at their debt financing going from 4% to 7% to 300 basis points. That's just like remortgaging a house. Say somebody in Toronto or something that was paying 2%, now go back 5 years later and they got to refinance at 5%. And it wouldn't be that hard to figure out how that would impact their earnings. You just typically take their $20 billion in debt, multiply it by the 3% difference, see what that is, deduct that from their income, and then divide it by shares outstanding. And you could see now, to maintain their dividend, maybe the payout ratio jumps quite a bit. I haven't done that. But I have to admit, I was a little bit surprised at that. So again, I got to keep that for now. So this is going back to the Fed again. So back in 2009, one of the biggest things with that crashed the market was mortgage-backed kind of securities, where they take all these mortgage, put them all together and say, well, it's diversified, and then get Moody's, who they pay to rate them, and say they're AAA. And we know that whole house of cards collapsed. And one of my theses has been the whole time from 2009 till now, nothing has really changed. We didn't see anybody in the financial industry go to jail. We saw some legislation come in, but then it's been watered down again, especially with Trump coming into power. So what we have now is what they call collateralized commercial real estate, CLOs, which have been growing and grew in recent years. Credit rating firms have repeatedly changed their ratings assumption in ways that catered to the bond issuers that pay the firms for the letter grades. So that made it easier for the issuer to sell more AAA bonds, some of which have been downgraded in recent weeks as the coronavirus pandemic shook global stocks. So again, it's just kind of a replay. Now instead of private residential real estate, we're looking at commercial real estate. And to me, Moody's and these rating agencies should be nationalized so they're not receiving these financial incentives. Like if you're a company, I'm a rating agency, of course the company wants the best rating, and you're paying me to give that rating, and if I don't give you the rating you really want, you're going to shop around for another rating agency to give you that. So it's just not not a good thing for the capital markets. Again, as far as money spending, with the fourth pandemic relief package, this one now $484 billion, expected to pass the House of Representatives. This year's budget deficit, so that right now, it'll probably be worse, the deficit in the United States will be $3.8 trillion, or 18.6 of gross domestic product. I think their GDP is around 20 trillion or so. This is the highest since 1945, after World War II, according to the Committee for Responsible Federal Budget. And also predicts the federal debt, the net debt to GDP will now be over 106%, matching the same record in 1946. So that was after World War II. You know, when companies were nationalized to produce tanks and everything else, and we're running deficits equivalent to that. And that's just showing you the shock this COVID-19 is having. And again, we kind of continue to see the disconnect between financial data coming out. Car manufacturing went from, I think, 15 million down to 11 million. So there's 4 million less cars being produced on an annual basis, so on and so forth. And last week the market was fairly flat overall. It had some volatile days, but at the end of the week I think it was just down a little bit. I did